What's up everyone, David here. So what's a good strategy for an investor that wants to buy and hold and not be stressed about what's going on day to day in the market? The answer is index funds. Thanks for tuning into this episode of Why This Man Always Leaves You Disappointed, sponsored by my wife. Wait, we're not leaving that in there, are we? Index funds are offered primarily in two different ways by brokers. First is through an actual index fund that usually requires an account with that specific brokerage and also sometimes a minimum investment in order to even get into the fund. The other way comes in the form of an ETF or exchange traded fund that mirror an index. These are available to buy and sell on the open market like any stock and don't require any minimums or have a specific brokerage to participate. Before we get any further, if you don't have a brokerage yet, feel free to use my link to Webull in the description below so you can get the chance to win 2 free stocks valued up to $2,300 total when you sign up and make your first deposit. All right, cue the intro. Okay, so I'm gonna go over what these funds are, so if you already know all of this, feel free to skip around using the timestamps below. Basically, an index fund is a pool of investments that you can buy within your brokerage account. The fund itself buys and sells what's inside of it without you having to do anything. These funds are diversified, so it gives you all the benefits of owning hundreds, if not thousands of companies, even though you only had to buy one fund. Let's look at a stupid analogy I came up with to help you understand better. Let's say you manufacture semiconductors and the entire world relies on your one factory for those parts. Man, this seems kind of familiar. This is like owning a single stock. If the factory shuts down, you're screwed, just like if you have all your money in one stock and the company goes under. Now think of 1,000 semiconductor factories. If one shuts down, everything is still fine. If you own an index fund with 1,000 different stocks and one fails, it's really not that big of a deal in the grand scheme of things compared to if you just had one stock. This is the principle of diversification and is a great way to spread out your risk when investing in the market. Index fund creation is credited to John Bogle, who was the founder of Vanguard, and are a staple of guys like Warren Buffett and Kevin O'Leary from Shark Tank. With all that said, let's take a look at 5 of my favorite index funds in no particular order. First off is going to be VOO. VOO is a Vanguard ETF that tracks the S&P 500. If you didn't already know, the S&P 500 is made up of 500 of the largest US companies, and by buying into this ETF, you get exposure to all 500 of them with one package. This ETF has great sector exposure, helping its overall diversity. You can find information technology, healthcare, consumer discretionary, industrials, and many other sectors in this fund. None of the current sector allocation in the fund are over 30%, so if one sector in particular takes a tumble, you won't feel the entire loss compared to if you were in an ETF tracking just one particular sector. If you want to see exactly what's in this fund, doing a quick search of the ticker will take you to Vanguard's breakdown of what holdings the fund has and the sector allocation percentages, so you can see for yourself. This ETF has an expense ratio of 0.03%, which is very low and why people like this fund so much. Basically, this means that if you have $10,000 invested, you will be charged $3 per year for being in it. There are other index funds with lower expense ratios though. The best I can find is a Fidelity exclusive fund called FNILX. This index fund has a 0% expense ratio, but you can only get into it if you have a Fidelity account. Unlike a lot of exclusive index funds, it also doesn't have a minimum required investment. Vanguard's version of this index fund, VFIAX, has a $3,000 initial investment and an expense ratio of 0.04. If you have Fidelity, it might be a good idea to take advantage of their 0% no minimum index funds. If not, you'll be more than happy with Vanguard's ETF VOO, but be sure to look at your specific broker to see what they offer. Schwab has been lowering their index fund expense ratios and getting rid of minimum investment requirements as well, so they can become more attractive and competitive with people like Vanguard. Man, I really do love free market competition. The main point here is that being in something that tracks the S&P 500 is a great place to start when building a portfolio quickly that also has a lot of exposure to many different stocks. Next up is going to be total stock market ETFs and index funds. Now, just like the name says, these are going to be invested in the total stock market and are seen as a safer play over the S&P 500 since instead of being invested in the top 500 companies, you are invested in over 3,900 companies, as of right now at least. This is kind of the ultimate way to become extremely diversified by just purchasing one fund. Since it encompasses everything, this fund relies upon the overall upward trend of the stock market in general. With that being said, let's start with the ETF version that is available to everyone. This is going to be VTI, and again, it's a Vanguard ETF. Just like VU, it has a low expense ratio of 0.03%, and like any fund, you can check out all the details about it, including sector allocation, historical rates of return, and risk level. These will all change over time, so make sure to look up the most current information. All of this is readily available by just searching the ticker symbol in Google and going to the broker's website that it belongs to. If you have Fidelity, then you may want to look at FZROX instead of VTI. This is another zero expense ratio, no minimum index fund that they offer to their clients. Again though, don't get caught up chasing specific funds, since most large brokers offer good index funds with competitive expense ratios for their clients. You just need to look up whichever broker you're using and see what they have to offer. If your broker doesn't offer a good competitive choice, or they do offer it but the expense ratio is too high or the minimum required investment is too much for you, you can just go with the ETF offered by Vanguard. Now let's look at some options for mid and small cap investing. Investing in these kinds of companies gives you the opportunity to have large returns when these smaller companies end up exploding in growth. But that also makes them inherently more risky, since smaller, newer companies are usually not as stable as the big dogs. If you're looking for an ETF, then Vanguard is the choice again, and this one is called VXF. This ETF seeks to track the performance of all US stocks that are not in the S&P 500. It currently has an expense ratio of 0.06% and has roughly 3,500 companies in it. And don't be fooled, just because it has small and mid cap doesn't mean you won't recognize some of the names. Uber, Square, and Zoom are all in the top 10 holdings of this ETF. If the 0.06 expense ratio is slightly too high for you, which it's really not, honestly, Fidelity once again offers another 0% expense ratio index fund for their customers called FZIPX, and it has no minimum requirements. If you're looking for a similar index fund with another broker, look in the category of mid-cap blends to see what your specific broker may offer in that category. Let's take a look at a more safe choice for an index. This ETF from Vanguard is called VTV and seeks to match the performance of many of the largest value stocks in the broader market. It has an expense ratio of 0.04% and holds around 350 different companies like JP Morgan, Intel, and United Health. Looking at it at the time of this video releasing will show a solid 10-year return of 12%. This is another solid long-term ETF offered by Vanguard to consider adding to your portfolio with strong, slow-moving companies that should continue to provide a good rate of return for years to come. Note that this fund does underperform the S&P 500 funds, and based on investing $10K into each of these 10 years ago would come out to be an $8,000 difference in profit. Even with that, it's still a solid choice and a good pick for someone with a little less risk tolerance than I currently have as a 31-year-old. As I get older, this may be one that I keep my eye on once I start getting closer to retirement age. All right, last but not least, let's look at some funds with international holdings. Many experts tend to say that having some international holdings is good practice for diversifying further. Remember that not all household names are companies inside the US. Getting into an ETF like VEA from Vanguard is a good way to get a piece of the pie from companies like Nestle and Toyota. This ETF holds over 4,000 companies and has an expense ratio of 0.05%. I personally have a lower percent of my overall portfolio in international investments because historically they tend to underperform the funds we have already talked about in this video. I personally think it's important to have that diversification in case something weird happens in the US markets and international markets aren't affected. If you have Fidelity, they have another zero expense ratio index fund called FZILX, and it holds just over 2,400 companies at the moment, and it has a similar rate of return as other international funds in its class. If you use them, be sure to take a look. If not, don't sweat it and just go with the ETF instead. If you appreciate the time and effort I put into these videos, please leave a like and subscribe so you don't miss any of our content. Links to beta test our new social investing app are in the description, as well as a link to sign up for our weekly newsletter. The first 2 weeks are free, so you don't have anything to lose. Also, be sure to check out our Facebook group so you can connect with the 25,000 other investors on there in a spam-free environment so you can talk about trades and different investments. Thanks for watching, guys. I'll see you in the next one.